Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us for a few minutes here where we're going to go over a couple of topics that we and our advisors handpick for you that we think you may find some value in. So this week, we're going to talk about alternatives, take a look at that asset class, as well as long-term performance of individual stocks. You won't want to miss that because you'll find some, I promise you, some very interesting statistics and really challenge the way that we think about long-term investment in stocks. So make sure you skip or get through my part and get to Andrew's where you'll really find those nuggets. But we'll start with some alternatives. So if you were at the Thirdly in the spring, alternatives were certainly a big piece of that. We make sure and hit at least once a month or so inside the Market Carver. So not a two topic for you, but worth repeating because this is really where a big piece of the investment landscape has changed. A lot of these vehicles previously existed just for the ultra high net worth, either your institutions or your $25, $50 million and above portfolios. But that world has evolved and more of these things, which have been the exclusive domain of those types of investors, more available to the rest of us. And so when we say alternatives, and internally we use the term core plus, just in case you see that on your portfolio assessment or your advisor talks to you about that. So we have our core investment models like Tactical Edge and Balanced and a few like that. Those are our core models, so we call our alternative investments core plus. But when we say those words, there's really a slew of different categories, and those are listed here on the screen. You got private equity, private debt, hedge funds, real estate, commodities, collectibles, and structured products. So we're not invested in all seven of those at any point in time, but we do think there is a great value in putting a mixture of these alongside our core portfolios. And the benefits of doing that are they can reduce risk. They can reduce risk because they can perform differently than our regular stocks and bonds. They can have their good periods in times where public markets don't, or vice versa. So that diversification helps reduce risk, or it can magnify returns by having access to things that grow really fast or are really good over time. By giving up a little bit of liquidity, they can help magnify returns. So they can do both of those things as well as enhance tax efficiency. So here as of late, private debt and structured products, which we use as structured notes, you might have heard those terms. I'd say those have been the two biggest, as well as some real estate, though there certainly is a growing place for private equity and a limited place for hedge funds. So when you see us talk about alternatives and adding them into the portfolios, when we look at the returns and look at risk and reward charts, it really does a great number by having a 10, 20, or even 30% allocation into these alternatives. So when your advisor talks to you about it, that's why. So as promised, Andrew's going to talk about stocks for the long term.
Thanks, Adam. So there was a really interesting study that just came out I believe a couple weeks ago that was looking at the performance of stocks over the long term. Now, when I say long term, I don't mean just months or a couple years. This is looking back at stocks since 1926, looking at all publicly traded common stocks, 29,000 of them to be exact, and how they've performed over decades. And then obviously some are going to be trading longer than others, but actually looking at how stocks performed that entire period, and some really, really interesting results came out of that. We've always heard the belief that just buy and hold, close your eyes, ignore drawdowns, ignore market volatility, and things will be okay. And that axiom applies to many topics investing-wise, but it doesn't necessarily always apply to really long-term results for individual stocks. And that was one of the big takeaways from this study. Now, the first chart I'm going to share with you is the one on your screen, looking at the mean cumulative return of all those stocks, all 29,000, and then the median return. And you'll notice they're drastically different. And we have to distinguish the difference there. So when we talk about a mean return, we're just talking about the average. So the average return of all 29,000 stocks, over 22,000%. Really shows what compound interest can do. But when we start looking at just the median stock, so we look at the 29,000, look at the one in the middle, it's actually negative. It just goes to show that just how you have some stocks that perform exceptionally well can really carry the return, make that average return look so much higher. In fact, looking at those 29,000 stocks, 17 of them actually produced a cumulative return over 5 million%. Now, again, we're looking at stocks since 1926, so that's multiple decades of compounding. In fact, when we look at some of the best returns of those stocks, their annualized return was only 13.5%. We have to remember the market's average return is roughly around 8 to 10%, depending on how far we look back. So the best performing stocks in the world looking over that long time frame really was just a few percentage points a year above traditionally what the market produces on its own. Another interesting stack of that, looking at that, is the best performing stock was Altria. Out of all 29,000, Altria, you might know it as the tobacco cigarette company. It's been trading, again, since 1926. Its average annualized return was only 16%, and it was producing over 5 million cumulative return. And again, looking at that median return, we say that most stocks actually produce negative results. Many stocks go bankrupt. Many stocks maybe get bought out, or they're failed businesses. Not everything can be a success story. In fact, during that 98-year period that they studied here, only 38 stocks survived the entire time. Just a handful. Again, of those 29,000, only 38 actually were able to sustain trading during the entire time. Most stocks do see large swings of volatility. Those 17 that produced 5 million cumulative return, that sounds unbelievable, but it also brought with it some periods of massive volatility along the way, and goes to show really why it's so important to, again, not only look at what you're holding, but having a disciplined process and how to hold those positions through rising and lowering tides, in periods of volatility, and knowing when to have that proper risk management step in. Because again, the average, the median stock actually has a negative return. It's looking at just those massive gainers that were able to really get that average up. And so understanding that not everything is going to go to the moon or have phenomenal results, that many stocks actually do produce negative returns. And so it's critical to understand what you own, why you own it, and how long you plan to own it.
Very well put, and fascinating, as delivering as we promised. So thank you, and thank you to all of you for giving us your time. We sure do appreciate it. If we can be of service in any way, please give us a call, 800-928-4001, or scan the QR code and book an appointment electronically. So thanks again. Have a great weekend.